Hello, everybody. Today, I want to talk about the difference between buying your own home versus an investment property. It's a question that keeps on popping up with a lot of my friends, family, and I just thought we had to make this video. And today, I'm going to pull up a cash flow calculator to do a comparison between the two. I've invited Carla here, one of the Wealthy money lending specialists. She's going to verify a lot of the information relating to the loans. Now, one of the key things that I want to discuss here is, I guess it's about pain and profit, because people fall into the trap of chasing ultimate profit at the expense of their whole life. And the way that we think about investing at Wealthy is we want to make it easy. We want your investments to serve you. You know, we want to go and find good quality assets in blue chip locations where it's little to no effort on your behalf, so you can spend more time living the lifestyle that you want to live. I think it's a little too late if you've bought all these investments, you're struggling the whole way through. It's causing marital stress, ripping up your relationship with your friends and family. You've got to work overly hard, and you're always feeling at risk or not sleeping well at night, and starts to detriment of your health. I mean, how much are you willing to sacrifice in order to make money? I mean, that's really the question. Now, I feel it's a little bit long-winded, and let's just jump into the data. So, Carla, thanks for joining us today.
Thanks for having me today, Dom. It's very exciting.
It is very exciting.
Provide some insight.
So look, what I want to do is pull up two cash flows, and I'm going to ask you just a couple of questions about borrowing, interest rates, and how things are going to change over time. So let's share my screen. Let's start with buying your own home. Now, this isn't for everybody. I've had to choose some general numbers here. And what I'm doing here is I'm assuming that a lot of our clients are from Sydney, so it's going to be for a Sydney purchaser. And the average first home buyer, the average age is about 35. Is that right, Carla?
Yeah, correct, roughly.
Yeah. And, you know, when you're buying your own home, a lot of people are coming to us, and their first home, it's a very big emotional decision. They're doing it because they're buying it with their partner. They may look to get have children one day. They're looking at this first property, their own home, as something that they may want to live in for a long time. But it often comes at a cost, because they don't have enough money to buy what they actually want. So they end up buying something that isn't exactly what they're after. So it's something they'll probably want to buy and then trade later. Or they have to spend more money than they anticipated, so they're overexposing themselves and getting too much debt. Now, a lot of the people that are coming to me, they've got some good deposits. So let's run this scenario. I've got a $1.5 million property. I don't know what you can buy in Sydney for 1.5 million, but you know, you can buy some units, you can buy some houses, townhouses out of the city, like certainly not really city fringe, but $1.5 million. The stamp duty on that is nearly $70,000. I've got some conveyancing fees. And what I've assumed is that the person has got a 10% deposit plus costs. So they're paying 10% plus the stamp duty. I've put in a 7% growth rate because I'm assuming they might get a house here. And historically speaking, houses grow between sort of 7 and 8%. I've put CPI in at 4%. That impacts the cost of running the property. CPI came out the other day at like 5.2%. Now, this property here, when you buy your own home, it is typically what you want to do is pay down your debt. So, Carls, when you're going to buy your own home, and you're looking to do a mortgage, if you come in with 10%, how do banks look at you?
We have a number of banks that are happy to service a loan that sits at that LVR of about 90%. They're happy to have a look at that. But with the increase, like let's just say we're looking at a $1.5 million home, they're going to prefer that if it's going to be an owner occupier, that you're going to be paying a principal and interest loan. So that way you are paying off that principal part. And there are many banks that will be looking at that. However, you do run the risk, and you are seen as a bit of a risk to these banks because you are borrowing a lot of that cash. And in addition to that, you have to pay lender's mortgage insurance. So that, for someone who is looking at buying a $1.5 million home, will be looking at spending, anywhere between 50 to 100K on lender's mortgage insurance, which poses a
Let me
risk.
just pause for a second. So the LMI on that loan, can you just double check that and go to Genworth? I didn't know it was that much. I thought it was about 1.5%. So it was about 20K, but just double check that while we do this. But Carla is absolutely right. If you come in with a 90% lend, you have to pay lender's mortgage insurance on top of your stamp duty and on top of your deposit. So this is more cash. Now, the other thing is that banks don't look very favorably on you. So you need to do a P&I loan, principal and interest. So cut me off once you know what the LMI would be, Carls, but I'll continue. In this instance, we've put a 4% interest rate. Would you say that's about right?
Correct.
About
So
4%.
roughly at the moment, especially putting in a 10% deposit.
Okay, that's critical. So if you were to go and buy a $1.5 million home, you'd have to put 10% really minimum. You're paying stamp duty of about 70K. Then your interest rate would be about 4%, which is a little bit higher than the average because your LVR is so high because you're a bit riskier. Now, your out-of-pocket expense here is the interest, $54,383. I've put in some rates, insurance, maintenance costs. And then you've also got to pay down the principal component of the loan by about $24,000 per year.
Right.
And it goes up over time. Now, that means that your out-of-pocket expense would be $82,700. That is a huge amount of money, I think. That's after tax. 82,719 divided by 12, $7,000 a month. That's a lot of money coming out of your bank account every single month. Or 82,712 divided by 52, nearly $1,600 per week. So what was this, the LMI? Did you get that?
35,000.
35,000. That's $35,000. You have two options. One, it can be cash that you pay, or sometimes the lender will allow you to capitalize the loan. That means you can put it on top of the loan.
If you capitalize it into the loan, it then brings up your LVR. So you won't be sitting at that 90%. You'd be looking at sitting at 92%, 93%.
So now this is buying your own home. Now, let's have a look at what would happen if you were to use about the same money to buy an investment property. Now, at Wealthi, we really don't like to be too risky. We prefer to be a bit more conservative. We do work with what the client's parameters are and how risky or they are. But let's assume that that rough $200,000 that you put into that other investment, so we put $220,000, we put it into buying a $750,000 house. Okay. Now we're putting a 20% deposit. So that's $150K plus your stamp duty of about $31,240. Now, as an investment property, you get rent. You should get about a 4% gross yield, so $600 per week. I've put in a interest-only loan at 4%. Because it's interest-only, banks will typically they'll make you pay a little bit more interest. So isn't that right, Carls?
Correct. So you'd be sitting at for rent roughly, for interest rates roughly, you'd be looking at that 3.5 to 4.5.
Okay, so 4% is probably about the average that you could go and get. Now, in this instance, you also get depreciation, which you can lower your marginal tax rate. You can lower the amount of tax that you pay on the building. You get to depreciate the fixtures and the fittings. You really would have some small loan costs, but you wouldn't be paying LMI because you've got a 20% deposit. Now, I've in this instance assumed that you out there are on about $150,000. So let's run down the line. If we purchase this property, we put in a 20% plus cost and get $600 rent per week. Servicing only the interest, your out-of-pocket expense would be $326. Reason being is you get $30,576 in rent. You'd be paying interest of $24,121. And then you've got your rental expenses here, agents' fees, letting fees, rates, blah, blah, blah. Out of pocket per annum is $326. So it really doesn't cost you anything. Then you've got here all of your tax deductions. You've got about $48,000 in tax deductions. So you can use that to offset your income. So you'd be getting an approximate tax refund of $6,834. So after tax, this property would be making you $6,500. Pretty cool. So now you're saying, yeah, but Dom, there's a few things here that you've got to compensate. My own home, you spent $1.5 million and it's P&I versus an investment property, which is only interest only. But the point I'm trying to make here is that from a lifestyle perspective, here, this property here, you could probably go and rent this property for $1,000, $1,000 a week, probably less, like $800 a week. Okay, so you could go and rent in this home, this $1.5 million home for $800 a week, and then own this investment, which is making you $6,000 per year. The other thing that you can do is, in this instance, we're using way less cash than we are here. There's $40,000 less cash. And in time, you could talk to a mortgage broker. And because we've put in a 20% deposit, as the property grows, you can pull out equity without having to do the lender's mortgage insurance and buy another $750,000 asset. So you can have two $750,000 assets, total net assets, total assets, gross assets of $1.5 million. And those properties would cost you much, much less because you're receiving rent than running your own home. So let's have a look at the equity position over time. In this instance, your equity position, because you're paying down the property, is about $1.8 million after 10 years. This property here, it's $872,000 plus every single year you're making between 7 and 10K. So over 10 years, let's just say it's about $80,000. So 870 plus 80K, it's about $950,000 in equity on this property. If you've got two of them, 950 times 2, it's about $1.9 million in equity that you would have over time. Now, the thing here is you're out of pocket here, $82,000 a year. If your wife or your partner wants to have babies, not go back to work, that's a huge amount of stress on your household. If interest rates go up, it jumps $10,000, jumps to $100,000 a year. So that's a tremendous amount of pressure on your family. If interest rates go up over here, you're still collecting rent. It's still positively geared. It's negative here, pre-tax, but post-tax, it's still positive. So the point I'm trying to make is that having an investment versus your own home, it is a very deeply emotional choice. Comes down to what you want to do. But if you're thinking about lifestyle and profit, the way that I like to look at it is probably go buy investment properties. Take a more conservative route, collect rent, collect some tax, get the growth. And when things get tough, if interest rates rise, you can always up your rent. Whereas if you bought your own home, if interest rates rise, you've just got to pay more money out of your pocket. Maybe your partner needs to go back to work. What if you lose your job? There's so many things that can go wrong over here as your own home, which scares the crap out of me. Whereas as an investment property, you really are much, much safer. Now, Carl, now that I've kind of gone through that, are there any questions or things that come to mind for you?
Yes. So a lot of clients will come to us and say, look, I want to buy my first investment property. I sort of want to combat interest rates though. Interest rates are rising, like that will affect my repayments. How can I basically beat that? And a lot of the times I'll say to clients, like ways that we can have a look at that is the way that we structure your loan. And by making your money work harder for you, by creating an offset facility for your interest. So if you create an offset facility for your loan, you can then also save that additional money by offsetting that money to your loan amount, which means you're paying less interest. So over that duration of the loan. And
so that's a really good, let's just pause on that. What Carla's using some technical terms here. Effectively, if you've got your loan, you can set up a separate account. And if your loan, say $100,000, you're paying interest on the $100,000. But if you've got an offset and you put $10,000 of cash in there, now the loan amount you're paying interest on is now $90,000 because it's offsetting, the cash is offsetting the loan amount.
correct.
Cool. Yep.
That's one way that you could combat, interest rates, which is a lot of questions at the moment with interest rates rising. And in addition to that, it's also having a really good team behind you, being able to structure that loan for you, and also having the right team to help you structure this investment for you and finding the right thing for you. A lot of people go into the mindset that we need to purchase together to get this property, and we need to purchase to buy this home so we can eventually buy our future home. Or we have a lot of questions of clients who are saying, my partner and I don't know what to do with our money. We want to go buy our first home, but we also need to make some more money, and we're worried about what's happening right now. I always refer back to the point of try and make your money work for you. Try and figure out ways to see how you can make more money from your properties. And like you said earlier, rightly said so, by having an investment property, you can get higher rents, and you can have a look at structuring your loan differently to be able to make that income work for you.
Two important points. So I like that you're asking questions and then answering them, which is great. But let me point to something here as well. You know, if this person had worked their ass off and saved, $200,000, $230,000, they maybe should have invested earlier. Instead of trying to save your way to your own home, because people want to get a bigger deposit as possible to go and buy their $1.5 million property. So they try and save $200,000, $250,000, $300,000. Another way to do it is to invest your way to your own home.
Sure.
So you can go and use maybe $70,000 to go and invest in a $500,000 property or a $400,000 property. Or take your $100K and invest it in some smaller assets that will grow and make you money, that will lower the amount of tax that you need to pay. And in time, you can sell those assets. You're not married to your property. The property doesn't have to stay with you. It's like a business. You have to make business decisions. And if this property wasn't serving my interests, or if this property has already done everything that I needed to do, you can sell it. In the 5-year mark, you say, listen, I've got $500,000 in equity. That's great. I'll sell it, take that $500K out, and then go look to buy my own home. You can, maybe the 2 assets, you could take those 2 assets, sell one, clear the debt on the other one, start getting an income. I mean, personally, I'm now looking at, I've got 3 properties that I'm looking to sell because I do want to buy my own home. Now, I get this. I'm not heartless. There comes a point where you do want to buy your own home. I'm doing it for strategic reasons, because you can buy your own home, you can do some work to it if you're handy, and if you sell it, you don't pay tax. And some people want to buy their own home because they want that stability. There's a number of reasons why you want to do it, but you can do it in a more sophisticated way. You can do it by being patient. You can do it in a way where you don't risk your family, you don't risk, your state of mind. You don't have to risk it all. You don't have to put too much pressure on yourself and your family. You can have the best of both worlds. You can live in a great area, live where you want, and invest where you can afford. Carlos, thank you very much for today. I really appreciate your time. I know you're busy, and thanks for helping us with some of the lending stuff. Any of you out there are interested and want to know about what you can afford, reach out to Carla and the Wealthy Money team. They can do borrowing capacity. They can review your loans if you've got any. They can see if you've got the best rates or the best structure. They can see if you've got equity to maybe purchase your next property. There's so much value in talking to mortgage brokers because they've got 50, 60, you've got all the major banks plus all the second, third tier lenders on your books. And very, very quickly, they can just tell you how much you can afford so you can get so you can start shopping. Anyways, have a lovely day. Happy investing, and hope to hear from you all soon.